So that brings us to the special speech section. Our special speech speaker today is Vamshi Krishna. He will be presenting his effective coaching level 4 elective 2. The objective of the project is to create a podcast. The speaker is a software engineer, is super interested in learning things, and will be learning the art of investment from our own president of the club, Ramesh, today. His topic for the podcast is Interview an Investor. The investor role is being played by none other than Ramesh. Please welcome Vamshi Krishna.
Although we more famously know him as Mr. President, today I required ask him to put on the hat of the investor. Oh yeah, and so Ramesh, have you put on your hat, the
Yep,
investor?
yep. I
Okay.
have my investor head on now.
Now, before I even start anything, most of us are here are salaried employees or own our businesses. But we have a person here today who was a salaried employee at one point of time in his life, and he was something which I am, a research engineer. And from that point, he moved on to become a full-time investor. So that's what he does full-time today. So let me directly get into the gist of the interview and ask you, Toastmaster Ramesh or Investor Ramesh, what was your driving force to take up investment full-time?
Okay. Thank you, Vamshi. So, before we start, I'd just like to say that everything that I say here is my opinion and it's not any investment advice. It's just my experiences as an investor. So, to answer Vamshi's question, why I went into investing full time. So, there was actually a push as well as a pull. The push was even though I was doing quite well as an R&D engineer, I found that I was spending more time justifying why I wanted to do the R&D that I was doing to management rather than actually doing it. So that was a push. The pull was I had been investing for a long time. As soon as I started working and I had some money saved together, I had been dabbling in the stock market. So that was the pull. I had enjoyed doing that. So there was a push and a pull as the reason why I went into investing.
Very interesting. So you mentioned about the push and the pull, and I really want to focus more on the pull part, as in what pulled you in investing. I okay, and I see investment as a huge ocean, and whenever I've tried to go there, I get confused by various types of investments. So there is stocks, there's bonds, there's gold, there's a lot of things, and I just get confused and I end up doing nothing. So could you please tell us, like in simple words, so that we could understand what would be like broad categories of investments which you do?
Okay. So the main categories of investment are the biggest is real estate. The second biggest is bonds. The third biggest is securities or stocks. The fourth biggest is gold. The fifth biggest is collectibles. Now we have a new category, which is cryptocurrency. So to elaborate a little bit more, real estate, I'm sure everybody is familiar with real estate. So bonds is a promise to pay a certain amount of interest for a securities is the same as stock, which is a company giving out shares in order to get money to do whatever business they want to do. Gold is, as you all know, gold is gold, and collectibles is like art and other collectibles. So all and the newest is cryptocurrency. Is now being considered as an investment. Is also cryptocurrency. These are all stores of value, and this is what they consider as investment.
Just curious, Ramesh. So, as a beginner, which of these should be ones we should be looking at? Because I tried looking at cryptocurrency, but I found it to be too fluctuating and risky, at least for me. Any advice on that for us? Like which areas we should be looking as a beginners?
As a beginner, first you need to determine what kind of investor you want to be. Are you a passive investor? Are you an active investor? Are you a person who is better at fundamentals? Are you a person who is better at technicals? So I'll just elaborate a little bit more. For an active investor, it means that you select specific stocks. A passive investor, your timeline is in years and decades, and it means that you select more industries and countries. For a technical investor, it means that you are focused on the short term. It means that you are looking at how many buyers and sellers are at any particular time. For a long term, for a for a fundamental investor, you are looking at it in the long term. It means that you are trying to determine whether the value of a certain investment versus other investment. What is the value of a certain investment versus all the other investments? So they say that in the short term, the market is a voting machine. That means what matters is the number of buyers and sellers in the market. Long term, it's a weighing machine. It means that you weigh the particular investment against all the other investments. That's how you determine the value.
I see. So if I were to like
Okay.
look at it, I mean, they would be.
So,
Okay, sorry.
sorry. So you were asking which is the best for a beginner investor, right?
Yes.
So beginner investor, I would say you is better to go to fundamentals and to be a passive investor. So you look at it in the long term and you look at it in terms of industries, because that is from past historical experience. It generally seems that the economy is always the GDP is always growing, which means that if you look at it in the long term, you have an advantage. So for a beginner investor, that is the area that I look at.
That brings me to a very interesting point, actually. I always thought of myself as a fundamental investor. I always used to, like, I always think of a long term vision for whenever I invest, at least 5 or 6 years. That's what my long term
Okay.
is for now. I'm not sure if
Okay.
that would you consider that as a long term or a 6 year period, or will it be a short term?
Uh, I would characterize five. Okay, it varies for different people. So for me personally, long term will be more in the longer than it'll be about 5 to 6 years, 2 decades. That would what I would consider as long term. Because if you just look at the S&P 500 from 2000 to 2010, it was flat. That means if you had bought the S&P 500, S&P 500 is the index of 500 stocks in the US. And you consider that is considered like one of the key index that everybody uses to determine their how well they're doing in investments. If you consider that index between 2000 and around 2000 and sorry 2007, the index was flat. So if you had bought say $1,000 worth of the index in 2000, in 2007 it would still be worth 1,000. So if your holding time is 5 to 6 years, then this would not uh, be within your timeline. But in the long run, that index has been returning about 5 to 7% CAGR. CAGR is compound annual growth rate. That means over the very, very long run, it has been returning about 5 to 7%, actually a bit more than 7%. I think if I'm not mistaken, S&P 500 has been returning about 10% over the very long run in decades. But within a shorter period of time, it may not be that.
Mhm. Interesting. So it means if I were to put money directly in S&P 500 index without even worrying about which company to put in, I would be getting more than 10,
Yeah.
like almost 10% returns over a long period.
Over an extremely long period of time,
Oh,
yes.
quite interesting.
That is based on historical,
Mhm.
uh, based on past history, yes. But it also determines on when you put in. So if you put in at the top, I mean, say for example the peak in 2007, then your returns will be lower than if you had put in nearer the bottom. So even when you go in, it's better to go in tranches. That means you split up your money into segments
Mhm.
and then go in a certain segment at a time. This means that your risk profile is uh, is more gradual. So you will not. It is unlikely that you'll be going in right at the top, but at the same time, it's unlikely that you will also be able to go in right at the bottom. But as an investor, you should not be looking at going in right at the top and right at the bottom because market timing is very difficult. Very few people can actually do market timing. So what they try to do is come up with a system which minimize the need for market timing.
Mhm. That brings me to a very relevant question, at least which I have in my mind, which is okay. So to give you an example, I recently purchased gold in India
Okay.
at 50,000 rupees
Okay.
for 10 grams, and this was in January. Now the gold
Okay.
has like gone down to 45,000 rupees. So I've like lost 5,000, and I feel
Uh-huh.
very bad about it. And
Okay.
I feel like I should not invest anymore, and I should keep. So how do you deal with failures, or like how do you like accept risks in your, because you're doing it full time? So how do you accept risks, and what's your coping mechanism with it?
Okay. So this is a very good question. This is one of the most important questions that every investor has to ask themselves even before they buy a security, even before they make any investment. What are you going to do when your investment goes against you? So whenever you make an investment, you must make sure that no matter what happens, you must be able to sleep at night. If you can't sleep at night, there means something you are there's some problem with your investment or the method of investment, your method of investment. So in this case, so for me, as you say, there's a lot of stress. I deal with stress by doing a lot of physical exercise. So physical exercise helps me deal with stress. And the other way that I do is in my portfolio, I have a large percentage of cash. So this is part of portfolio management. So you have the investment. Generally, okay. What you are trying to do is decrease the volatility within your portfolio, which means that ideally, you should have two investments, both of which are going up in the long run, but one of which, when one goes up, the other goes down, which means that you reduce the volatility within the portfolio. For example, stocks, previously they used to use stocks and bonds. Generally, when the stocks go up, the bond price goes down. When the bonds bonds go up, the stock price goes down. So what they used to do is when the stocks go up, they would have that means they always allocate a certain percentage to stocks and certain percentage to bonds. When stocks go up versus the bonds, that means the percentage of bonds in the portfolio would be going down versus the uh, percentage of stocks in the portfolio. So they will just take sell some of the stocks and put it into bonds so that the ratio is always the same. So in this case, when one goes up, you push it into the other one, and when the other goes up, you push it into the other one. And that way, as long as both these uh, investments are going up together, the overall portfolio volatility is reduced. So that is a part of portfolio management.
This sounds so much of thought process going in. I thought investment used to be like I mentally felt it could be easy, but looking like hearing about all these balances and all, I no wonder why you are doing it full time.
Yeah.
So
So it's
can you tell us because of like because you talked about balances and also looking at the market and then making active decisions.
yes.
How does a typical day for you is a trading day?
Oh,
Like, are you always hooked on the TV like they show it in normal investment?
no, for me is I like investing. So basically, I do it all the time. Whenever I have free time, I'm doing either learning, researching, or thinking about it. That is, you need to remember that you're competing against everybody else in this game. So you need to have an edge. And one of the edges that I have is basically I can do it more than other people. So I can, because I like it, so I can do it all the time. So that is one of my edges. So uh, I don't I don't look at, for me, I'm a more of a long term investor. I would say mid term, not really long term, but mid term. So about generally 1 to 5 years. That is my, for most of my investment, that is my time scale. So more of a mid term investor. So in that case, I do most of my time is spent on research, researching the fundamentals, researching about the technology of the company, researching about the. So our investment is a, it's a multidisciplinary. I find it that it's very disciplinary in nature. You need to understand a little bit of economics, microeconomics, macroeconomics, geopolitics, technology. You need to be able to read financial statements. You need to go understand the management. You need to be able to understand psychology, a little bit of psychology, market psychology. You need to be able to manage your emotions. So it's quite multidisciplinary and it is not static. So you always be learning. The, the stock market is always moving. That it means that the knowledge that you have to gain needs to keep on increasing. If you stop learning, other people catch up. And once enough people catch up, your returns will drop.
I see. So it's
So
always it's like a running race where you always try to be in front of the whole.
yes, that's right.
Interesting. Okay, so I have many more questions to ask you,
Yeah.
but I would also like club members to pitch in. So anyone has any doubts about investing or wants to take up any tips from Ramesh? Note he's a full-time investor, so he knows what he's doing. Not me. I cannot give tips on investing. Uh, so you can ask him, and you can put it on the chat, or you can directly interrupt me here and ask the questions if you want. So I'll leave it for a minute if anybody has any questions. Okay, so we have a question. What is your view of Bitcoin? It is from Minhua.
Okay. Bitcoin. I don't understand Bitcoin. I haven't put in enough effort in Bitcoin. So I don't invest in Bitcoin at the moment. I can't really say I don't have an opinion on Bitcoin. I'm sorry.
Okay, okay. It's actually very relevant in a way because Bitcoin is so evolving and vague. I mean, a lot of us have the difficulty in understanding it.
Yeah.
Maybe somebody should research it and put it in a club speech. So that's a nice idea.
Yeah.
Another question we have from Rahul, which again is something which is very common, which is like increasing day every day, which is Robo Advisors.
Okay.
I get a lot of emails also that there are these algorithm traders,
Mhm.
robo traders who buy and sell just on basis of their algorithms. So,
Yep.
what's your take on it? Like, would you be ever considering that? And what's your take on it, like in general, the robo traders?
There's a few different kinds of. I would say that if you say robot traders, there's actually a few different kinds of robot traders. certain kinds of robo traders are those created by the banks, the big banks, where they do high frequency trading using robo traders. Then there is this long-term robo advisors where they give investment advice to uh, people. So those are more of long-term robo advisors. I would be careful of robo advisors because to be successful, if you want to be an active investor, to be successful in the stock market, you need to be in the minority and you need to be right. If robo advisors are giving everybody the same advice, then it is unlikely that you can be in the minority. And that means that your risk profile is actually higher. If everybody's given the same advice, that means they cannot get the returns that they are looking for. They generally cannot get the returns that they're looking for because risk and uh, rewards. So if you take more risk, you get more rewards. But how you reduce the risk is by having more information than somebody else. That's how I look at it.
I see. Quite interesting. There's a recurring theme of questions which I've been seeing in the chat, which is uh, advice on what to invest on or what areas to look at, what kind of securities and all.
Uh-huh.
And before we go there, I have a question from Puneet. He says, right now with the low interest environment and the bond yields at all-time low, what would be your recommendation for long-term bond investors?
Long-term bond investors, I would say that they have to be very careful. I don't have. I'm not holding many. I'm not holding bonds now. A long time ago, the bond interest rates were high, so the risk reward was in favor of bonds. The reason being, if the even if the interest rates uh, went up, it is likely that you still will not be losing as much money. But in this low bond environment, there is a higher chance of the interest rates going up, which means that you are more likely to lose money in this investment in the long run. If, say, for example, inflation goes above the interest rate that your bond gives you, it means that your real interest rate is below the rate of is below the your real rate is below zero, which means that you're losing money every year.
Interesting. So this also means that whenever we are investing, we have to also take the inflation rate in mind when we peg our returns.
Yes.
So if inflation is say 7% and say our returns are 5%, so we are actually like, does it mean we are losing money?
Yes, you're losing money because what matters is what is your purchasing power.
Okay, makes sense. There's one question which I have for you, where I want to like take you back in your own life.
Okay.
And what I wanted to ask you is, with the current experience you have right now or the current learnings you have,
Yeah.
what would be that one thing or couple of things you would have done differently in investments early in your life or over the period?
That question is actually very hard because everything that happened, you have to learn from it. And I feel that I've learned from every experience. If I already had the experience, then I will be using the experience to not make the same mistake that I would have made. And my returns will probably be higher, but I would not. I think I would not do anything different because all of it is part of the learning process. There's if you don't if you if everything comes easily, sometimes you tend to take more risk than advisable. So I don't know whether I would have done anything different than what I did.
On a lighter note, had I known, if I had knowledge of today, I'd have
Okay.
definitely gone back and purchased a lot of Tesla and GameStop stocks.
uh, yeah, but 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 the problem is you will not know when to hold, when to fold. That is one of the most important things that you have to learn. And when to know when to hold and when to fold. What I mean by that is when you have to hold the security and when you have to sell the security. And that can only be learned through experience. You might have bought Tesla, but when Tesla in a couple of years back, no, a couple of months back, Tesla went down from 900 to 400. So that is more than a 50% drop. Would you have held it, or would you have sold it? This was before it was before they did the split 5 to 1 split. So at certain periods the stock will go down significantly. So knowing when to hold and when to sell is very important, and that can only be done. That you only get that through experience.
Great, interesting. This is a key message. I'll hold on to this message and not fold the message at least.
Okay.
Nice message. I'll keep this with me.
Uh-huh.
And I think we are almost coming to the end. So I'll quickly wrap up with one wrapping up question for you,
Okay.
which would be like many of us are not full-time investors, and I'm not sure if we would all want to become full-time investors. But if you could give us a couple of advice on how to become a better investor, what would be your advice for us or for Changi May Toastmasters Club as a whole?
So first you need to understand what kind of investor you are. Whether you're a long-term investor or a short-term investor. Whether you're a technical investor or a fundamental investor. Each of this requires different skills. And once you determine what you are, then you have to learn as much as you can on that particular area and your investment orientation.
Okay. So I guess the major advice here would be to first understand your style and then learn according to that style.
Yep.
And I'll keep that in my mind. Thanks a lot, Ramesh, for agreeing to be interviewed in front of the club about your career.
Okay.
Thanks a lot. And I request all to give a huge round of applause to Ramesh.
Here, 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 here.
Here.
Thanks a lot,
Right,
Ramesh.
thank you.
And if anybody has any other questions, Ramesh would be happy to answer them on WhatsApp. You could ask them in the club group or to him privately. And I'd again reiterate what Ramesh said in the beginning. His whatever we have talked till now, it's just his views, and they do not constitute an advice as to whether you should go and buy something or not. If you do that, it's just on your own head. So, just a legal disclaimer. And so from my side, I learned a couple of very interesting things, which I feel that I should do, or I should be keeping in mind whenever I want to be successful in stock trading or in investment. The first thing which I feel is the word spoken by Ramesh, which is you need to be in minority and you need to be right. So with that, if I were to relate that knowledge today, so I would not purchase Bitcoin because everybody is purchasing it. I would not be in the minority. So just my view. But I see what Ramesh meant by being in the minority and being right. So you have to be ahead of the market always. And the other thing which I felt is when to hold and when to fold. So having that pulse would be the one of the key differentiating factors between a good investor and a bankrupt investor. Um, so with that, I would like to thank the whole club for lending their 30 minutes. And I would like to have such similar discussions on careers of other members. I hope it was a good experience for all. And to understand what Ramesh does for his full-time, like this is his full-time job in a way. And one thing I would like to add here, I had a pre-interview talk with Ramesh last week, and I'd asked him a similar question that what motivates him or how does he work whole day on investment? And he says he doesn't feel any pressure because he loves it. And that brings me to the concept of ikigai, where you have like three circles: what you're good at, what you're passionate about, and what brings you money. So I feel that in our club, our president has found his ikigai, which is researching and at the same time getting money out of it and being a trader. And that's why he's so successful. So again, I would like to thank Ramesh for being here. And I would also like to hear feedback from all the members later on WhatsApp or on Zoom chat on what or who would you want to be on this hotspot next time. Thank you.
Thank you, Vamshi.